Welcome to Stock Watch with me, Ntaoleng Lechela. Now joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Shane Watkins from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at Business Day TV using the hashtag StockWatch. Gents, thanks so much for your time this evening. Grant, I'll start with you. You know, just when we thought a trade war was brewing between the EU and US, President Trump backtracking on his tariff threats, further saying that parties have agreed on a framework deal on Greenland. Another case of Trump always chickens out?
Yeah, absolutely. The Tucker trade is alive and well. I think we haven't learned that now. We're never going to learn it. And there's definitely an element of, I was surprised at the market's reaction because, to be honest, there's a bit of headline fatigue with all this back and forth, and it's on, it's off, it's this, it's that. So I think it pays markets and investors to look through the noise and understand what's happening in the bigger picture. There is a fragmentation of global alliances. Trust is being broken. You know, monetary systems are being rethought. Stores of value are being repositioned. That's where gold and precious metals and commodities is coming in. And that's really the big picture. What he does from day to day with what was once an ally is tomorrow a foe, then it's a friend again. That trust is breaking down gradually, and it's going to mean a gradual bleed out of the US dollar into other asset classes or other stores of value. And it's not going to happen overnight. It's not going to happen in a big bang. I think it's just going to be a slow bleed over time. But of course, those incremental moves are so significant in commodities as an asset class because there is so much liquidity in the financial system. And I think that's what we're seeing play out.
Let's dig deeper into that then, Shane. You know, Trump meeting with NATO's SG, on one hand, the president saying that a framework has been reached for a future deal. Then on the other hand, the SG saying Greenland sovereignty was not discussed at that meeting. There still seems to be so much uncertainty, and Grant there mentioning that perhaps we should just look past those headlines.
So, Ntaoleng, I agree completely with Grant in the sense that trust has been broken. And as you know, in any relationship, once trust is broken, it is difficult, if not impossible, to re-establish. Now, 65% of the total global market cap, the total global equity market cap, sits in the United States. And a fair portion of that is foreign investors. You've already seen a large Swedish and a large Danish pension fund saying that they are going to sell all of their US treasuries. So the likelihood is that either there are flows out of the United States, or alternatively, there are fewer further inflows. So the likely outcome of that is that probably a weaker dollar, and probably other markets will do better than the United States. The United States market itself may also actually do well because Trump has indicated that he's preparing a stimulus package ahead of the midterm elections. So there are tax refunds going out to families in the United States. There are various other stimulus measures. So if you see the stimulus measures that he has in place ahead of the midterms supporting the US market by itself, and you see money that would have gone to the United States buying other markets, ironically, we could still see quite good performance from equity markets globally this year.
And yeah, you talk about state funds and stimulus, and a company that's been a beneficiary of state backing is Intel, right? That group out with results after the bell, and there seems to be so much confidence leading up to the results. Grant, what will you be looking out for when it comes to those numbers? It does seem like many analysts, many investors are betting on that turnaround story.
Well, the turnaround story is already, I think it's gone up 2.5 times from the lows, or if not more, supported by government investment and NVIDIA. And I think the first point is this company probably should have died in its current form, given how poorly it's been performing. Those bailouts definitely helped. They've rolled the dice on the new sub-2 nanometer production, 1.8 nanometer cutting edge. They've leapfrogged TSMC, but quite frankly, TSMC has out-operated them for the past 5 to 10 years. AMD's taken their market share in the CPU market. So I'm really interested to see, are they actually able to deliver on the most cutting edge node of where they are positioning from a semiconductor production point of view. If they can't deliver there at scale and at a profitable level, this to me is just another poor investment case of poor returns on capital and wasteful capex. I think what's saving them is this national imperative to own strategic assets. And let's be honest, semiconductors are very much a strategic asset nowadays. And so the US will bail them out continuously, as long as it takes, is what I think.
It's a national a gift that keeps, I guess the state is a gift that keeps on giving for Intel there. I'm going to give you another question, Shane, looking at the GLP-1 drug makers. Now, there's a question here around with those patents expiring in major markets. Some companies are already eyeing Canada to test out generics. I think Aspen's one of those firms as well. Is this a game changer, and what could this do to Eli Lilly and Novo Nordisk's pricing power?
So, Ntauling, obviously, as these patents expire, they have quite a significant impact on margins, because as you enter the generic market, the margins are significantly lower. I would say that the GLP-1 story has largely played out. And in that sense, you know, the benefit that these companies are getting from the GLP-1 drugs is now fully priced in. If anything, there has been some evidence that the GLP-1 drugs have some side effects that are not favorable. So I don't think I would be buying any of the global drug companies on the basis that it's the GLP-1 story can accelerate from here.
Okay. Your thoughts around that, Grant? We do know that, 2026 has been dubbed the year of the obesity pill.
Yeah, it's really interesting. I mean, I share Shane's sentiment. That exciting growth story has largely played out, specifically with Novo Nordisk, who doesn't have a lot of many alternative products. I mean, this is pretty much all they are as a business. Eli Lilly at least has other revenue streams, and they have also been, you know, Eli's been gaining share over Novo Nordisk for a number of years now, and I think that's a bit of a concern from that point of view. I think the oral is going to be important. I think that potentially could expand to a much broader market, and we'll see whether that elasticity of demand kicks in and supports a rapid increase in sales volumes, even at lower prices. But I think, you know, to Shane's point, it's unclear that the margins can support this generic, you know, this wave of generics coming. Not only that, they've got those biosimilars where the guys are making it up. So there's already that pressure that's coming through. I think it's probably safer to stay out of this one.
Okay.
If I had to pick of the two flagships, I would pick Eli Lilly, simply because it's a better business with more diversification.
What do you think about Aspen's value proposition within that market? It already does sell the Eli Lilly's products here in South Africa, and of course looking to get into the generics market.
Yeah, I like the fact that they are positioning in there. I mean, they're moving into Canada. I don't see what their advantage is. I don't think they have any distribution there existing already, and I don't see how they're going to penetrate that market. But certainly, Aspen is really about a capacity utilization story, and I want to see, that's what I'm looking for out of Aspen. I like that they're positioned in GLPs where we know there's growth and demand. Potentially, the generics can really support their production facilities. But I think that's there's still some capacity they need to fill in that regard, and so I wouldn't buy it on that business case alone.
All right, Sasol, Shane, up what, 14% today on the back of that operational update, where it also lifted annual fuel sales on an improvement in operational efficiencies. Your thoughts around that update?
Ntauling, so essentially, I think the market had expectations of volume growth of about 3%.
Yes.
And they came in and said, you know, it's going to be in the range of 5 to 10. So certainly it was a beat. The fact that the share was up 14, I think, speaks to the positioning that people have in the share rather than the extent of the beat.
Okay.
And what I mean by that is that there are a lot of people that are either underweight or short Sasol, and so you get this excessive reaction to good news. So I think that explains the share price move today. And I think, you know, there is a risk that when Sasol runs, people that are underweight are forced to chase that situation. The oil price, in fact, was down today, and Sasol was up, which is slightly unusual. But obviously, as you said, driven by the trading update. I think that there is also some upside risk to the oil price. There's been some extremely cold weather that has shut down operations in the Permian Basin in the United States. And obviously that, together with the possibility that the United States could attack Iran this weekend. I remember the aircraft carrier group will arrive in the Middle East sometime in the next 2 days. So the risk is that that could also impact the oil price, and I guess people are worried about that.
I think I even read a report by the International Energy Agency where they also upped their demand forecast for oil this year on the back of an improved economic outlook. Your take around Sasol, Grant, it's a lot of analysts have painted it as one that's, a trading stock, right? Because of its cyclical nature and how it's also influenced by oil and chemical prices.
Yeah, look, it was a surprisingly good trading update. We're not used to seeing that out of Sasol, but I think the last one was also a slight upside surprise, as the operations generally have disappointed over time. We've not typically been a fan, but I think there was a bit of apparent value in the 60s and 70s. We still have a small position in it. And I think it's really a beneficiary of what's happening globally. As Shane alluded to, there's certainly a risk-reward potential in the oil price here. If you look at global energy stocks, they're all at new all-time highs, and they're all breaking out as we speak. And commodities tend to move together. It's not often you see the commodity complex rally on a sustained basis while oil is going down. So I think there's some positioning there. Emerging market flows are driving it as well. It looked to me like a lot of foreign flow into SA today. Sasol, still one of the largest stocks in the index, and I think they benefited from that. Plus the positioning, as Shane said, there's probably a lot of shorts. Remember, Sasol fell from over 120 to 100 in only the space of a week or two recently. So I think it's a combination of all of those factors. I don't think Sasol has turned the corner fundamentally in terms of its management and its operations, but perhaps there's signs of some improvement there.
So still one for the riskier investor.
Active management is what I would use there.
Now let's get into some of the SA Inc. stocks. A question here on Mr. Price. We've been getting loads of questions following that bid to acquire NKD out in Europe. Investors not liking the move. We've seen that share price really tumble since the announcement. Your thoughts around that? There's been, of course, investors really pushing back on that deal, Shane.
Untelling, so I think investors don't like the deal, and I would say for good reason. People probably won't remember, but Mr. Price went to Chile about 25 years ago, and they left after 5 years. They then went to Australia, and they left after experimenting there for 5 years. Many South African retailers have gone offshore, and they have not done well at all. I mean, who can forget Woolworths buying David Jones? So there's not good evidence that our expertise translates well offshore. And I would also say that there are other deal-specific reasons why I think this is a very unattractive transaction. In the first instance, about 65% of this business is actually in Germany, which is a developed market. And, it's hard for us to understand where Mr. Price thinks they have expertise there. In the second instance, they're buying 100% of this company. And so ultimately they're going to have to dilute down themselves to incentivize management, because Mr. Price have said they're not going to manage the business. So they're actually kind of paying 110 to get 100. And then I think, if you look at the track record of this business, it's made losses in the last four of the last 5 years.
Yeah.
So it does feel like it has been dressed up by private equity to sell. But having said all of that, it's very hard to see how they get out of it. It's not subject to shareholder approval. And so, they're in a catch-22 situation where they either proceed with a bad deal or they have to pay a hefty premium to the vendor to extricate themselves.
I mean, Grant, Benguela making it known that they are opposing that deal. And to my understanding, the JSE rejected Benguela's request for the board to recategorize that acquisition. Take me through some of your concerns there, Grant. Is it more maybe shareholder oversight?
Yeah, I think that's definitely a part of it. I think Shane touched on a number of the issues. South Africans do not have a good track record of going overseas successfully. We've seen Truworths, Woolworths, Spar, even Tiger Brands up in Africa have destroyed significant value over the years. That's the first one. Second of all, they're not buying a good business. Mr. Price is a quality business, cash generative, healthy balance sheet, net cash position for, it's regarded as a quality retailer. The business they're buying is not quality. It's poor quality. It's got some of the lowest margins out of the entire peer group. And they've barely made any money for the past 5 years. And Mr. Price is paying a premium multiple at that. So it's earnings dilutive, not earnings accretive. It's in a structural decline in terms of market share in Germany. As Shane said, that's their biggest market. And then they've said they're going to leave the current management there to continue as is. So how do you extract value from a poor business by doing nothing? You're just buying it and then sitting and hoping it turns itself around. So realistically, that's you're either going to end up having to pump money into it, or you're going to hope for a miracle, because Mr. Price has no unique expertise they can bring to the table, and they've said they're not even planning to bring anything to the table. So we don't see the value unlock theory there either. And I think the other point that's worth making is around the private equity sale. We've seen it, remember, with Edcon. When the private equity buyout took place. By the time they sold that business, it had been stripped of all value. There'd been no reinvestment in the business. The stores were tired and old, and they'd literally run it into the ground. And I think this is exactly what's happened here. So your financial metrics are as good as they're going to get. You can be sure they've overburdened this business, and they've underinvested in this business. And that's typically how the private equity model works. Squeeze every drop you can out of it. And so we think this is a fundamental shift in the business. If you take the sequence of acquisitions they've made incrementally over time, and now they're repositioning, adding this massive, and it's quite chunky as well. It does fall below the shareholder approval threshold, but that's probably where the concern arises, is this changing the fundamental nature of Mr. Price's business? And surely shareholders should have a say in what's going on here, because it can be material. How much more do they have to pour in? I think, if you look at Spar in Poland, you didn't think that was too material, but look how much extra capital they had to write down, and the debt got lumbered onto the SA balance sheet. Mr. Price has gone from a clean balance sheet to it's going to be a debt on the balance sheet. They said it's going to be long-term debt, so there's obviously no prospect of paying that debt down anytime soon. So really, there's so many question marks here, and I think shareholders should have a say in this matter, really, just in terms of good governance. It just asks way too many questions from what has historically been a well-run, high-quality business.
Yeah, I mean, it's really a big story, and it's something worth noting. And Mr. Price, I guess, really has to start speaking and answering to some of these questions. And we will try our best to perhaps get Mark Blair to come in and, maybe do an interview with us so we can answer some of those questions. I want to move over. We're still talking acquisitions, right? But in the banking sector. Shane, a question here around local banks expanding, or rather going into East Africa. We recently had Nedbank make a bid for Kenya's NBCA group, if I'm not mistaken. ABSA's been snapping up some of these East African players as well. What do you make of that, a region that is said to, be growing exponentially?
Darling, Kenya is growing, the GDP is growing at about 5 to 6% per annum. So it is if you compare that to South Africa, which is growing last year maybe a little bit less than 1%, perhaps we grow 1.5 times this year, perhaps 2% in 2027. So they're buying into a market that is fundamentally growing. But again, South African banks have also not shown themselves to be the greatest acquirers of offshore assets.
Yeah.
Remember, Nedbank have just sold EcoBank in Nigeria. But I think that we have to give Jason Quinn the benefit of the doubt on this. I think he's an extremely competent and quite conservative operator. But, I mean, he's up against history where 80% of acquisitions in the world fail. So I think he's a competent executive. He's got good judgment. But, the odds are against people that buy companies that other people want to sell. I would just say, though, that the business that he's bought has an ROE of 18% versus Nedbank's ROE of 14%.
Okay.
So it seems a good business, but, time will tell.
Yeah, let's wait and see. Now, before we get into stock picks, Grant, let's look at clicks, right? Turnover there up 7%, mainly being boosted by pharmacy sales as well as a record Black Friday performance. I saw that the share price took a hit. I think it was down 6% by the close. Is this on the back of that hit they're taking in the Western Cape?
Look, that's a part of it, and that was, supply issues that they were experiencing. Availability wasn't there. But it was so ultimately it disappointed a little bit on the sales side. But
okay.
The thing that stood out to me wasn't that one-off, which typically those kind of things are. It was the competitive pricing pressure. So there was fierce competitive pricing from, we know who the competitor is, it's likely Dis-Chem, over the key festive season, and that put pressure on sales. And that tells you of a tough environment, and that isn't one-off typically. So it tells you that these two are competing fiercely with one another. Perhaps this is going to put pressure on margins as the two, Clicks, if they want to fight back, they have to do the same. They also have to discount. And so you don't want to see these two in a price war, certainly not as an investor. So look, Clicks is a great business, great management team. I don't think there's a fundamental issue with the business at all, but it did disappoint slightly on results. And then you question, is this a difficult environment for now while they're operating, and should we hopefully see a consumer, this might be a good entry point into Clicks, because actually it's trading relatively cheap compared to its history.
And I was thinking about that, whether the promotion activity we saw in the festive season could be then, squeezing markets on that front. All right, let's get into stock picks. Shane, I'll start with you. Where are you seeing value at the moment?
And Tarling, I would like to recommend the JSE. As everyone knows, the JSE itself is a listed company. The market cap is 12-13 billion. The JSE is extremely cheap. It trades on about an 8% dividend yield, 11 PE. The historical PE is on average about 13 and a half times. But the thing that drives the JSE is trading volumes. And if you go back 18 months, the JSE was trading about 20 billion a day. Today, the JSE traded 43 billion. And again, I think as Grant earlier alluded to, we're seeing foreign investors becoming more active in emerging markets, and South Africa is part of the emerging market complex. And so the thing that's going to drive JSE volumes and hence profitability is going to be trading activity. And I think this is going to be a good year for emerging markets. It will probably be a good year for South Africa as well. The volumes on the JSE are already up significantly. And then, if I overlay that with the fact that it's a fundamentally strong business model, and the fact that they've got a new chief executive officer, Val Reddy, who I think is an extremely competent executive running a business that, close to has 100% market share in what they do, I think it's a good opportunity and it's extremely cheap.
Grant, are you betting on SA Inc. and the EMs or going into developed markets?
No, we don't need to look overseas when we've got all we need right here, Darling. My pick is Old Mutual. It's really a catch-up trade. The other insurers have outperformed. For many years, Old Mutual has struggled, I think, a little bit for leadership and guidance. And they've got Yuri Stradum there. There's a clear plan. They've still got a very strong brand in the niches in which they operate. It's trading really cheap, 8 times next year's earnings. Good dividend yield. But it's been a story where they've struggled to turn the ship around. It's been this big beast with all this potential for many years. I think we're seeing signs of a good CEO making a difference. You've seen at Tiger Brands what a good CEO can do. You've seen at Momentum, if you think back to where they were 5 years ago, with a good CEO bringing in what he's done for that business. I think you're going to see the same thing in Old Mutual. On top of which, you've got this groundswell of interest in SA, particularly the financials are a natural beneficiary of strong financial markets, of the yield curve tightening, the strong rand. So there's a lot of tailwinds, a lot of interest in SA Inc. And I think this is the beginning of the story, not the end. Last year, we outperformed significantly, but that was really all about the precious metals and the commodities. The money now filters down into the rest of the market. And I still remember the 2000s, the commodity boom of the 2000s, and let's hope we see that again. You certainly want to be invested in South Africa for the ride.
All right, gents, thank you so much for your time and sharing your insights with us this evening. That's all for Stockwatch today. Thanks to our guests, Grant Nader from Benguela Global Fund Managers and Shane Watkins from All Weather Capital. Up next, the close.